Okay, good morning, gentlemen. We have our continuing ACS educational sessions. We have Fish Eyes and Swimming the Market in attendance. Today is November 20th, 2016. Full disclosure, this is purely for financial education and not for any solicitation or advice. We are going to cover a broad range of topics within the next hour, which I believe is going to be hugely beneficial for going forward and specifically looking towards the end of the year. That's our time frame that we're really looking at. We're not going to project too far out. Saying all that, let's quickly skim through a bunch of charts to give us a broader view, and then we are going to discuss some of the more micro aspects of trading, and also field a couple of questions that you guys might have. So first and foremost, one second here. I have the wrong screen on. Okay, there you go. That should refresh on your side right now. Yes?
Multi-year breakout level.
Okay, good. So this is I'm going to just go through the charts that I've been watching very carefully in managing my trades, sharing with all you guys, and seeing what I see. So this is a extremely important chart. I highly recommend that all of you use the investing.com platform. This has been very, very helpful to me among using the other more, I wouldn't say complicated, but more detailed platforms that I use, Quad and Thinkorswim. But this gives you a great bird's eye view. I think that's the best way to describe it, of what's happening with the markets. Lines are very clean, as you can see. We're going to go through each one of them, and you can, and without getting into too much analysis paralysis, it's pretty clear as to what's going on, at least on the broad macro front. It always surprises me, always amazes me, but I guess that's human nature, that so many out there, very intelligent charters and technical guys and so many different things that I scour, that they are still very bearish. And I have no problem being tactically bearish, but looking at certain charts like this, looking at the seasonal factor where we are right now with Thanksgiving week shaping up in front of us, it is very hard to make a powerful case of a massive breakdown. However, we all know anything can happen. But saying all that, the form and the structure, or what we call market structure, as you both know, is pretty clear, and the pattern symmetry is pretty glaring as to what's going on. The question that everyone should ask themselves, and I think I certainly do, is that these patterns are truly robotic. Look at what happened back in January and February. Look at the big reflex bounce that continued for a couple of months. I am not saying in any way or form that we are going to be having that size bounce, given that we were coming off some pretty deep oversold levels at that point, at least on the price level, from the 1800 level, if you guys remember. On Brexit, we were coming off the 2000 level. Here we are coming off roughly the 2100 level or 2080 level, whatever the case may be. So obviously, as we are climbing higher and higher, you are going to have these reflex bounces, in my opinion, if you notice, getting shorter and shorter. So that's all fine and good, because what we're trying to do, as you guys have been are doing too, is we are playing the length of these structural bounces, keeping in mind that they are not going to be as elongated or stretched as they were when you're coming off some much deeper levels. You understand what I just said, right?
Yes.
Yeah, so it's a mathematical correlation where, in a way, it's a law of diminishing returns, in the sense that from the 1800 level, we got a bounce up to 1 second. Oh God, hold on 1 second. We got a bounce up to the 2100 level. So we're talking about a 2000 to 2100 point move on the Dow. Here we had a move from 2000 or 1990 to the August highs, which was 2193. So that's a 100-point bounce. So that was 200. Let me get this right here. Okay, so that was it. So this was a plus 200, give or take a few points. So this was a plus 200. This was roughly this was also one second. This wasn't plus 200. That was plus 300. Sorry. Yep. Sorry about that.
Looks like plus 200 on the next one.
Yes, this is plus 200 on the next one. And here we are looking at a roughly a plus 100 with a minor overshoot. Okay, so as you can see here, we are seeing a exponential decrease in the reflex bounces. So we have to obviously be cognizant of that. We're not asking for the moon. What we are seeing here on this particular bounce is a very similar pattern, and that's what we're going to look at right now. It's always good to remind, despite the fact what we look at, it's extremely important, which I found extremely important, is that we need to basically, let me change the color of this thing. We need to constantly look at these things to sort of train our brain to capitalize on these moves. So saying all that, generally speaking, at this point, I am basically looking at a retest, and that's why I had this vertical line drawn here of the 2195 level or so, 21, yeah, let's call it 2195, and an overshoot to 2200 on the S&P 500 as a logical extension of this move. Saying all that, some of these guys who basically blabber a lot, they're like, oh, well, at that point we're going to top and crash. Well, let's at least get there. And we have done extremely well in navigating these moves. So if we see where the SPX closed at, it closed at 2182. So realistically speaking, we have roughly 18 points on the max, and we have roughly 10 points on a short-term basis, which you can capitalize on. Saying all that, notice one thing here: we have a very powerful uptrend line, which intersects two major, touches two major inflection points. And if you notice something here, that we are now headbutting, for a better choice of words, against this uptrend line. If, which no one really talks about, we break above the uptrend line, which is very possible given the seasonal factor here, given the macro factors behind the market, which we have discussed extensively, and the force and the amount of money that's coming in from different asset classes, most importantly, the fixed income market. We talked about that months ago, and now it's happening, the rotation. It is very possible that we are, and the fact that so many, even till now, either have completely missed out, berating the market moves, or simply shorting. They're still shorting, and unfortunately, sadly for them, on a macro standpoint, getting extremely hurt. So the bottom line is, when you add those three major factors behind it, it is a high probability, that's the only way I can look at it, that we break out above this uptrend line. And if we do break out above the uptrend line, then we have the 2200 plus very much in the picture, 2210 or so, 2205, whatever the case. And this is a pure S&P 500 chart, not an E-mini chart. So you're looking at absolute numbers. And the bottom line is that no one talks about the fact what happens if we reclaim the uptrend line. So that's something that is a question mark that I ask myself, that if we reclaim the uptrend line, you might get a big exhaustion spike, which nobody's expecting. An exhaustion spike possibly of this length, of these 20, 30 point S&P lengths. So if you get one of those, because we are now above the uptrend line, over 2200, then we could get an exhaustion spike, which could be one of the final candles, short-term candles, of a short-term tradable high from a short standpoint. But the fact is, I have a strange feeling, and whenever I talk about these with you guys, and when I do the weekend sessions, they generally tend to come correct, that here we had the same situation where we had a minor consolidation after 3 very large candles, and same thing here. So here we have 3 large candles, 1, 2, 3. We had a minor consolidation here. Then and now we have a bull flag. You can clearly see that. That's a bull flag formation, which I've shown repeatedly over the past couple of days. So with a bull flag formation, you generally tend to get a breakout. So what I'm getting at is that we have to consider the situation, which I've gone through many times, that if we reclaim the uptrend line, there could be further upside beyond what we are talking about here. And there is ample juice on the side, cash on the side, to propel that upside, where not only retail investors, who have supposedly started to get back into the market after elections, which is a welcome sign, and that's going to propel the mutual funds, who basically rely on the retail investors primarily for their liquidity, right? Not the hedge funds. The hedge funds don't rely on mom and pop and their monies. Now, if mom and pop says, okay, we're feeling good, and we're coming in, and we're okay to put some monies back from our money market funds into the U.S. growth funds and all that stuff, then you're going to have a continuation pattern. So so I'm going to show you one other channel which shows what the level could be by the end of December, and that is something that Tom Lee, who has been one of the most accurate forecasters through and through, he's got his own firm now, Fundstrat. He used to be with, I believe, J.P. Morgan, and a soft-spoken guy. I know you guys probably seen him, Asian gentleman, and he's like he said, I think his target price is going to be correct. So in order to arrive at that, all we have to do simply is do this. We take this, we do so this is another level, if we want to be very okay, that's another one. All right, that brings us up to roughly 22, 24. And then you have a broader channel, which I think is going to be the most we can get out to the end of December. Oh boy, come on. There, okay? And that brings us up to 2268. You see that? So basically it's this one. This is the intermediate channel that we can get to. We could even get to that, I believe, by the end of November. Oops, what did I do? And this is the one that I'm looking at. And keep these in mind as you're trading the market, because without these bigger pictures, we all get very much swayed by what's happening over the short term. So this is the level that we're looking at, and that's roughly 2276. All right, and that, believe it or not, the big shot analysts out there are the ones who have been accurately predicting this move, and the top one being Tom Lee. That's how they're projecting it. So it's pretty cool that sitting here on a Sunday morning, we are, that I have projected before, and simply reiterating the same thing. and those guys are obviously getting a lot of media play, but hey, you know, we're on top of it too. So this is where it is. Now, let's look at the and if we're doing channel studies, which tends to work very well in these type of markets, as you know, a lot of my stocks nowadays are I'm using the channel factor, whether it be Amazon, whether it be Chipotle. You can see how accurate these channels are. So if we look at the lower end of this, and the point of inflection that I'm using is here, right? This major pivotal low, this one, we are looking at so we're looking at roughly about 2170 as a floor, because once we break that 2170 level, or let's call it 2167, which I've shown before, all of a sudden you get a waterfall decline, which comes about and tests the mid-Bollinger at around 2140. Obviously, we don't want to see that. However, from a very tactical standpoint, and you know, algos move well ahead of what our projections are. If you draw a downtrend line, you'll see magically that it is simply a retest of the downtrend line. Pretty amazing, right?
It gives you a big, that'll make a big right shoulder eventually.
That's correct. It will. The thing is that this right shoulder is well below. This right shoulder, honestly speaking, is 2124. By that time, there is going to be panic. The right shoulder will break. It will test this pivotal bounce, this hammer reversal right there. This one, right, of 2115. I can assure you that there will be stops triggered at that level, and you will retest this particular that's the reason why I've drawn this line, this particular level, which is around the 2080 to 2094. That would be pretty dramatic given the backdrop of the markets right now, and from a psychological standpoint, we don't necessarily want to go there, even though that would be a point of a powerful tactical bounce. All right, but just keep in mind that once we break, if we retest this line here, which is a possibility, 2140, you're talking about 40 S&P points, roughly about 200 to 240 Dow points. It can happen. Let's prepare ourselves for, because the algos can be extremely vicious even on Thanksgiving week, but then they would not wait around. Excuse me, I was sipping my coffee. So they wouldn't break around, wait around. They would immediately start a reversal rally towards the retesting the lower end of this broken channel of 2168, and it's going to be very fast and furious. Which brings me to a point. You all have noticed that even on slow days, the movements in the reversals, up or down, are so quick that it's just mind-boggling. It seems like the machines are getting faster and faster and faster. And I think we, as from a trading standpoint, we have to be cognizant of that. All right, that they don't wait around one bit. Once these tactical levels are tested, to turn around and just go and run up like a monster. Right? You guys both agree with me on that?
Yeah, I've been using shorter and shorter time frames just to keep track of what's going on.
Absolutely, absolutely. So remember one thing: it's a double-edged sword. The shorter time frames have a lot of noise, which we're going to see today. We've talked, So in a way, they're fantastic for identifying, like we talked about extensively in one of the previous sessions, in identifying the reversal candles. Now, whether that reversal candle is going to be a continuation, we have to immediately switch and then wait to see whether that forms in the hourly charts, right? So, yeah, exactly. So the double-edged sword remains because there is so much noise on the 15 minutes, on the 5 minutes or so, and we don't know, and that's the nature of the beast, right? We don't know exactly what's going to happen within the next hour if we are doing the SPX thing, unless specifically on the quad, and then secondarily on the TOS, the internals are very deep oversold. Unless that happens, we don't know whether that continuation is a valid continuation bounce or whether it's just simply a quick short cover, and then all of a sudden you get another large candle sell candle coming in, because the machines are just doing that. Because the bottom line is the hedge funds are day trading, so obviously it becomes a little bit more difficult. But saying all that, let's keep in mind that the inflection levels of where we need to think more about the short side is right here around the 2169 or so, because the break of that would immediately change the short-term trend bias towards this point. All right, so just keep that in mind. And like Jim said, if we do create a right shoulder, then obviously we are looking at the right shoulder creation at back in the 2120 levels of the 2115, 2120 levels on the S&P 500. So we're clear about that. This chart has been extremely helpful to me, and of course we need to focus on the shorter term to see what the bounces are. But what I'll be watching very carefully on Monday is how well we can hold this 2170 level, and how well we break out over the 2196 level or so. I'm sorry, 2195. All right. And anywhere in this zone, you will see automated sell programs, because there are sell limits here automatically put when when we had hit the previous high. So again, just manage it as much as you can and don't go too much overboard. As we all know that if a lumpy position in an SPX options can be extremely lucrative when it goes our way, but a lumpy position at one go is not a very pretty sight when all of a sudden it starts going the other way, right? So yeah, so just manage that, because the swings are so quick and fast. Having 4, 5, 6 SPX calls, all of a sudden you're down 3, 4 points within 15, 20 minutes, correct? So yeah, all of a sudden you're down like $1,600, like for what? But then that's the nature of the beast. But these things help, and it's very important that we keep an eye on that. As in the background of what the macro factors are, that's my job to put out as much as possible on the Twitter feed, and I certainly do that. And keep that in the back of your head as you're doing that. Okay, now that we've covered this part, let me save this. Certainly use investing.com, this particular daily, and we're going to now look at so now let's look at the ES channel. I think this was from the 18th. Okay. So this is another version of the chart, right? Anyone who says that, there's a lot of people not believers in technical analysis and stuff. I mean, how can you not be? I mean, these are so defined, it's not even funny, right? It's just like makes life so much easier when you can see a depiction of the market in these structural forms. You both agree on that? I mean, obviously you both agree on that. That's why we're all in the same boat. So here we have a beautiful. This is E-minis. And so here we have a beautiful depiction of range trading. That's really what it is. So we have a lower end of the range at 2175. That's roughly about 2175. And here we are with this is the E-minis. So basically on the E-minis, if you're as you're using this, and I put that up as much as possible, we're looking at 2176 on the low end. That's the short term. That's the short term 5-day type of range that we are trading in. And the lower end of this, which we broke out of on the 15th, right there, and we kept on testing it. We almost made a lower high. I'm sorry, a higher low, and now we have entered this zone here. So as you can clearly see here, we need to break out on the E-minis over 2186.94, call it 2187, in order to establish this continuation pattern going forward. Saying in the meantime, if we do this, it doesn't harm anybody, even though non-technical, non-focused charter traders who are not following charts will freak out. We can very easily drop here and do this, zigzag a little bit, and then break out. As long as we hold on this coming week, okay, as long as we hold the 2168 level on the E-minis, 2168, okay, as long as we hold 2168, gentlemen, we are fine. If we break this level, do not be a hero. Do not be like, oh, we're going to have a tactical bounce, things are oversold. Pure price function. They will drop the market very quickly, and there will be a zigzag pattern to test the critical support that's at 2148. So 2148 is S2. And if you notice, they are in increments of 20 S&P points. I said this a long time ago. The S&P traders generally trade 10 to 20 points ranges, right? And you can see that very clearly. This is on a 1 hour chart, so you can see that very clearly that this is a 20-point drop, and this is basically a and this is a roughly 20-point thing. This is actually a plus 20 from here. If you use this as the baseline, plus 20. Minus 20. So remember, 2168, put it down somewhere in your head or write it down, is the level that you don't want to mess around with. If we break that, you generally want to be short biased. Fair enough?
Got it.
Jim, you there?
I got it. Yeah.
Okay, good.
Muted, sorry.
Yeah. So the levels to watch, 2168, and then you'd be targeting 2160 as the first stop, which correlates with this support level, and then you'd be targeting 2148. So at that point, breakage of this, in my opinion, would bring in the short bias, and if 2160 is lost, it's going to fall rather rapidly, even though there's going to be zigzag, little short covering bounces, this and that, but it will fall rather rapidly to the to this bottom critical level. If this breaks for whatever reason, and I'm showing you obviously the bearish point of view in the market. If this breaks, then we're in trouble. Okay, and it can be very lucrative on the short side. If this breaks, we have a very large first bounce on the 9th, right? So we could very well fall rather quickly at that pivotal 2120, which is etched in a lot of people's head as a major, both on the S&P and the E-minis, as a level where the market should find major support, because below that, just psychologically, they're just going to bang the market down. All right? So that's it. So it's very well defined. I've been looking at it, and it's helped me a lot. These channels is what keeps you in the game. People who are not following this particular chart, for example, and you can please do set it up on your side. Very simple. Just put there, who's using, I know I've been talking, but any of you using investing.com at all?
I do.
You do.
I like investing.com, and then I also still like
which one? For your
yeah, investing.com works. That's fine.
Just stick to one, and then use my post for the other ones. All right.
Yeah.
So this way, because you're busy, you want to quickly look at it. This is the easiest on the eye, and then you look at my other charts and say, okay, let me do the other part of the job. This one you use from an MYOT standpoint, managing your own trade standpoint, as a roadmap. Tom, you using this at all? Tom? I think his daughter kidnapped him.
Yeah, maybe he muted.
I know. She's so cute. She's so cute.
Yeah.
Hey, Tom, you there?
Am I there now?
Okay. Yeah, you're here.
Yeah, she pushed the button on me.
No, I know.
I do use this one.
Yeah.
For the 1 hour and the 1 day, because it's white and it's easy to see the bigger
Yeah.
picture of what's going on, and I use
Okay.
Thinkorswim for all the, you
Other
know, I
ones?
mean, 15, 35-minute
Okay.
craziness.
Okay, that's fine. So this one just use, please, the 1 hour use for the channel depiction. Very, very important. All right? Because the channels are not that easy to see. Actually, they are not. They are easy to see on Thinkorswim too. But like you said, this is easier on the eye. The quicker our the neural network in our brain can pick up something, then the better we can react. Right? And it's some
Yeah,
of
the
those
white background.
the white background and the green lines and the red lines. So try to set it up prior to market trading this week, so that you have this in things. So that's it. 2175, 2168, and then you got this this drop if it gets there. On the upper end, we know very well. We talked about it that if we break out, one of the simplest way you can measure it is this is 2176. This is 2186 or 87. Okay, so that's 11 points. Add 11 to the breakout. Okay, so if you add 11 to the breakout, because the depth of the range, add up to the upper end of the range. So we are looking at 11 points from here. We're looking at 2198, right? So 2198 correlates with 2198. Add roughly 6 points to it. You're looking at 2204, right? Am I right? 2204 or so on the S&P, which correlates with what we talked about in the bigger picture. So this is your SPX, and all I simply did was 11 points here. Okay, 11, and you add 11 up here on any substantial breakout. And of course, this is not that the 11 points won't be in 2 minutes, but that's where we're going. These are your ES. So that would be point of maximum, in my opinion, short term for this week. Maximum move, the max move, as I like to call it. So that's it. Now, let's move on.
And on your exhaustion spike you talked about, are you looking at just the candles, or are you looking at volume to go with it?
I'm looking at both candles and volume. But
Okay.
I will do keep in mind that during Thanksgiving week, you generally don't tend to have very large volume. So I would give a little less weighting to the volume part. The real exhaustion might be in December, people coming back after Thanksgiving. And I think that volume part is secondary at this point, given the seasonal factor that we have a light volume week coming up. But you never know. In general, you're absolutely correct. A major exhaustion peak, exhaustion candle has to be accompanied by volume. So that you're absolutely correct on that. So let me save this. ES channel 1. Good. Now, what do we have? Now let's move this down to the E-mini part and make it into one. Beautiful. So a lot of noise. So here, if you notice, we have it's the 15-minute has been rather jagged, to say the least. This is on a shorter term basis, the head and shoulder, head here, left shoulder, kind of right shoulder. Here's the neckline at 2176, and below the neckline, you're looking at about 2169. So on a shorter term basis, you are looking at this as a major floor on the E-minis, 2170. You have a neckline here. You guys can see that clearly, right? Here's your neckline. Here's your head and shoulder. However, patterns completely morph into each other. I'll show you you guys can clearly see here that it's also a dragon bullish. You know what I'm saying? So head and shoulder with the left, somebody will say, okay, it's a left shoulder, right shoulder. If we break neckline, that's where we go. In the meantime, you can also draw it as a dragon bullish pattern, right? So, and the dragon bullish formation is more is complete or higher above this range here. So on the 15-minute, I've noticed over time, now that volatility has increased substantially and the machines are very much in control, that patterns do not try to be too much of a pattern reader into the shorter term and from a trading standpoint, within the shorter term pictures, in the 5 minutes, in the 15 minutes, because these patterns will constantly keep on changing. All right?
Okay.
Yeah, so just keep that in mind. Now, looking at that, let's take a look at the 1 hour. The 1 hour is more defined. This falls in with what we just looked at behind this, right? This, right?
Mhm.
This is the same thing as this in the formation. Now, what we do use, as we all three of us do, is we use the Darvas box. The Darvas is extremely important. There are many times I've wanted to on a candle a move. Let me just highlight this part. On a sell candle that I see noted coming in on the algo side, where we actually start to see it happen first. That's what I notice most, and then I switch. Then I just swivel to my other screens. Is I am tempted to short, but I don't, because I see that the Darvas box is constantly acting as a range. So if the Darvas doesn't break, even though there's a sell candle on the other side, I'm not going to go short because I'm going to lose money. It's happened before. Even buying 2, 3 right off the bat, within seconds, I could be down 3, 4 points. So the Darvas is extremely important and should be used very effectively when it comes to TOS. In fact, I find it to be one of their best features in doing that. So here's a 1 hour chart. We are looking good for the 1 hour. We ended the week with a very pinched Bollinger's. I'm going to pinch it to the point we can't see it anymore. I mean, look at this. Talk about, there is no massive massive sort of candle structures that we need to focus on. And given the fact we have a pinch Bollinger, we have stows that close the week in a very nice manner. You can see that. I like this a lot. I like this a lot. I like weekly finishes like that, where they are not finished here, because that means the first thing in the morning, if futures don't do anything, or if the futures didn't reset overnight, we would basically have, there you go. Okay. If we ended here, you know what would happen. Let's say futures remain flat, first thing in the morning, we would reset. So if we were long a couple of SPX calls that I am, as I posted, I have the ones for the 25th. No, I have the ones for the 23rd. And basically we would reset right away. So in that case, I would have to, again, cost average down. I like it the way it ended the week. That means I'm going to get a little bit of a burp up, and for reasons that I'll explain to you, which have to do with oil. And I will be a seller at these levels on my first batch of the calls. Fair enough? And that's sort of just my MO. You get nice 2-3 point move. You got a couple of them. You're starting the day off pretty nicely. And then of course you can rotate back. So on the 1 hour, we're looking good. This is pinch Bollingers like this I've seldom seen these are basically where the market is saying, okay, we're going to keep on digesting the moves. We're going to scare people by dropping quickly 10 points. Big frigging deal. Just look at the shape, look at the trajectory. There, it is telling you it wants to go higher. Any break below the, let's say, below, again, we talked about this, below the 2170 level or so, 2175, and then 2170, I'm sorry, what's this one here? Yeah, 2168. Then, we are having a quick short-term bias towards the downside. Let's take a look at the 4 hour. So on the 4 hour, we have a mixed picture. We have a minor topping process on the 4 hour. So that means that after the initial burp on Monday, let's say at the open, and vice versa, we could open down. We could possibly see a pullback during the day. So in that case, what level? Because right here, we're kind of midway, right? So we're midway. So if we need to reset on the 4 hour, and as you know, the 4 hours work in two segments. They basically work generally towards the end of the day, or by 1 o'clock. So if you're looking at 4 hour resets, don't expect it to happen by 10:30. The 4 hour resets generally happen midday and late in the afternoon, between 3 and 4. All right, giving you these are like, the specific SPX type of trading stuff. And if you look at the 4-hour, on Friday, they were sellers, which is what brought down the 1 hour to a oversold level. So these were selling on at, Friday was basically selling day, at least on the overall S&P E-minis. Saying all that, there's an old saying in the business. In bull markets, Fridays are sold and Mondays are bought. Why? Because people have profits. They want to take some profits. That's generally what happens. In a bear market, it's kind of the opposite, because people are generally short. Institutions are generally short, so they cover on Friday. So you get a up move on Friday because they're short covering and taking their profits. Do you understand what I just said?
Yes.
Exactly. All right. Saying all that, let's give Mr. Darvas the upper hand in determining, what this short-term movements are. We are in a very tight, what I notice here, we are in a very tight bottleneck. And what's nice to see is the stair-step pattern that we have talked about before on the thing. As long as it's stair-stepping higher, we are A-okay. Correct?
Yes.
There you go. There you go. That's it. That's your roadmap for this week. Period. A little dip here, little dip here, kisses the 34. And by the way, you guys are so frigging good at understanding this stuff, because when I need a break, I'm going to put you and Jim in charge of doing this stuff, okay? I'm serious. At one point, I'm going to say, 2 of my best chart readers here will actually walk you through everything, and here is Fish Eyes and Swim the Market to walk you through it, because believe me, you get it. So that's it, so there you go. So the 34 moving average is 21.72, and the 50, 21.63. This is the zone we need to hold. If we do not hold the zone, then we are in short-term down, what do you call short-term pullback level down towards this. Obviously, the 4-hour is the daily's first cousin. So you're looking at more intermediate type stuff. So this is the zone that we, so a test of the 34 is very critical for this week. 21.72, that's 10 points, right? Again, another 10-point move. This is a minus 10-point move, right? And then this one is another minus 10 points. So in other words, max that we can lose this week, and which will determine the fate of whether or not they're going to ring up November as a positive month, which I believe they will. Okay, then you cannot lose more than roughly 20 S&P points, because at that point you're going to break below the 50 SMA, and then there could be a possible minor trend change. Even though technically it doesn't damage the upside from the daily basis, it damages the intermediate structure of the market. So this is it, 34 and 50. We don't want to lose these 2 points and then stay long. Get it?
Makes sense.
And at the same time, if we do attack both these levels and not be able to hold, we are going to see Mr. Darvas then do one of these. Then we're going to see Mr. Darvas do one of this. He's going to stair step down a bit, correct? Mm-hmm. And he could just stair step down to here, because this was a major support, somewhere around 21.50. So you could stair step down here and not change anything other than scare the living heebie-jeebies with non-technical traders, right? We could stair step down here and just the way we, and test these lows, and then from here start to move up. There you go. So this would be then that would be a large dragon bullish, right? As we move through the Darvas. Fair enough?
Sure.
Yes.
I like today's session. Everything kind of flowing smoothly. Maybe because, you know, I had a good night's sleep. Just kidding. All right. So, and the cold air like woke me up. All right, baby. I love it though. Okay. So saying all that, um, we're good with that. Nice uptrends. We had a nice crossover here. The funny thing is, if you really think about it, and this is one thing that most people don't seem to get. It took me a while to get that we have these humongous moves, but the crossover of the 34 and the 50, which is so critical for a upside rally continuation, did not happen till hundreds of points higher, right?
Mm-hmm.
So honestly speaking, if somebody's just following the crossovers, we talked about this before, and let's say missed out in this whole, 2-day move before this large candle. In fact, the crossover didn't happen till the biggest part of the move was over, right? The crossover happened here. So if somebody buys the crossover, they still made money. They still made money. And the potential is they'll probably still make a little bit more money as we get that. But because the way the machines are set up, the best of that 24 to 48 hour, 72-hour rally is when the technical indicators did not even give you a signal, at least on the moving averages, correct? Certainly gave us a signal on the stows. Certainly gave us a signal on the stones. Same thing always happens. So if somebody's simply following the moving averages, which a lot of traders do, they just missed out. They just missed out. Not saying that they're not, like I said before, you might have missed out on the first leg of the big move. There's the next leg coming, but obviously I don't expect this to be repeated that soon before you get a nice reset pullback, right? So if we were, just to remind ourselves, this was the sort of the the canary in the coal mine that told us time to get out and not be short, right? Mm-hmm. That's basically it from the opposite end. So very, very important to do that. But when it comes to moving averages, it's certainly a big positive that we have the crossover, and the crossover is very much intact. And we're going to be monitoring for any cross under if that is the case, going forward. All right, let's take a look at the same picture, but on the SPX side. Now, at this point, you guys are focusing. I know. Jim is, but Tom, focusing on purely the S&P, right?
I've been branching out the last couple of weeks.
No, I'm just saying, no, I mean, what I meant to say was when it comes to the indices side, it's SPX, yes, not RUT, because RUT is very severely overbought here. Even though that's like a bull in a china shop, just breaking everything and going higher, we're going to take a look at it. I have been hesitant to really commit any type of real tradable money on the RUT, but we're going to look at it today, and maybe some things will reveal to us that it's going much higher. In my opinion, it's probably going much higher, but it is such a huge move. So from a technical standpoint, it's quite a bit out there. So let's take a look at the daily. Now the daily, if you let's do our standard deviation. Very, very important. So here we had a standard deviation of almost -7 from the moving averages, the highways, and the cross under, which was right there on the 18th. We had almost I would say -7 or more. So at this point, when we look at the move here, we have to measure it from here, actually. We are probably right now at look at the distance here, just visually. If this was a -7 or so, this would be like a +5 or less. This would be I would say it's a +4. Or 5. Let's take the on the side of caution. +5. Okay. So if it's a +5, we are basically going to again hit, at least retest the highs, possible overshoot, but we're not that crazy overbought yet, given the distance of the 50 and the 34. Got it?
Yes.
You cannot measure it from here. You have to measure it from the most relevant, most recent thing, S&P number. Now, what else do you guys see here, which is very positive, as in the shape of the 50 and the 34? We are about to get a 3450 crossover on the daily, which is huge. Okay? Or like good old Trump, would love to say, it's huge. So it is huge. If we get a 3450 crossover on the daily, we had the last 3450 crossover on the daily after multi-hundred point moves. We had it here. The rally continuation continued for a good another solid month. For what I'm getting at, I believe given the curvature and the shape of this 3450, if once it crosses over, you're going to have another rough month, another roughly 4 weeks overall of a macro rally in between, just from a swing perspective. That brings us to the end of December, the last week in December. Got it?
Perfect.
Yes.
So on your TOS, gentlemen, please, I'm going to be watching this too very carefully. In fact, this is the first time I'm seeing it. I love it because when I do this session with you guys, I mean that. I actually noticed things because I scanned it, but this didn't catch me because I was looking at the 4 hours, looking at the 1 hour, and I didn't get time this weekend to really sit down with this stuff. So this is key. This is key. Once you get this crossover, you know what I just talked about. Yes, Tom.
No, it's looking. I was just looking at the angle we've talked about in the past. The angle of the moving averages curling up is even steeper than
Yes.
the Brexit curl up.
Yes, because I believe that given what's going on the macroeconomic front, the certain policies, once we get a little bit more teeth into it, bite into it more as to what the nitty-gritty is, you are going to see Brexit on steroids. That's my opinion. Okay. However, knowing our sort of sometimes erratic, stupid, back and forth on the political side, our extreme nervousness and bears still hanging, and of course bears always have to be there, always like, pissing on anything, is going on out there, everything is bad, he's going to demolish the country, blah, 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 blah. You always get to see this nervous Nelly type of large candle retracements, just the way our system is set up. You guys both agree on that, right? Because
Yeah.
even now, given that it's pretty clear that these policies, one way or the other, infrastructure, you say, trade policies, which I don't think, and that's the biggest danger. Okay, we cannot pick a trade fight. We can pick tough negotiations, but we can't pick a trade fight because overall, markets are markets. Initially, they'll get very nervous. But let's say they smooth things and they one step at a time. They have to watch it very carefully. Most importantly, like I said before, the Treasury Secretary is very critical to the markets. And of course, and that's it. The Treasury Secretary is very critical to the market, and I know for a fact that the big boys are waiting to see who the nomination is going to be. So that could spark off that crossover, and not just the curvature. It'll just basically go like this. And remember, as you keep on having it, this is a very steep curve, no question about it, just the way Tom mentioned. And you had a very steep curve here, right? And this curvature looks very similar to this, Notice that, this one to that.
Mm-hmm.
You
Yeah.
guys can see that on your screen, right?
Yeah.
Mm-hmm.
Yep. So given that, and you get a spark, and then you get the cross. Let's say on the announcement of the Treasury Secretary this week, I think they'll try to do it before Thanksgiving, and I hope they do. You are going to see that large scale, multi-year type of breakout. Let me just put something very simply. We did all these machinations in the market, all this massive, the world's going to end, this and that, 1,000 point, 800 point halt limits, on election night, everything. But guess where we landed up? At the same frigging place. I mean, I'm looking at it very simple, okay? Same frigging place that we were at in August. So if somebody says, oh, market's really overbought, it's lost its head, and you're hearing this from hardcore, like, I monitor stock trades quite a bit. There's some real hardcore Trump guys in there, right? And the guys are like, they're like nutty. I don't know, some of them are just like wild. And now they're like, oh, short the market, it's moved up too much. I'm like, what are you guys looking at? I mean, sometimes you got to go with your gut sentiment. I'm very, very positive about how things are working out. Transitions are always messy, have to be handled. But now all of a sudden they're back to that, oh, market's a bubble and shit. I'm like, I mean, I don't interact with them. I mean, they love me. Some of them I put one comment up there. One of them is Mojo. Mojo Trading. He's like really like wild, like I don't even understand his chart kind of thing. But it's just like short the market. It's going to 1990. Okay, like not that I mean, me. I'm a solo player, and I've always followed that motto. It's the law of independence. I'm independent. I'll follow my theories, and of course, I'll absorb what's out there. But what I'm getting at is that these guys are now predicating Armageddon before even the new administration has even put things in place, and yet they are they are basically they were the number one positive guys, before the election. Do you understand what I just said? In other words, it's just like you can't like swing back and forth. You got to keep some sort of head. So what I'm getting at is that gives me an idea that the shorts are still in there. The shorts are still in there because that guy is a pretty powerful E-mini trader, and he's not the only one. And I've noticed that. So all of a sudden you're having a massive sentiment change. Charts are not showing that, but he's having a predictive sentiment change because Trump got elected and he's just putting things in place. So good. We'll just, we'll use them as a contrarian indicator. So saying all that, this let's watch this carefully, what develops over the next 24 to 48 hours, okay? So just to recap, we're going to watch this very carefully. We're going to watch the channels very carefully, and we are going to watch to see how the candles develop here, which I forgot to mention to you guys. On the daily here, one second, yes, SPX. This is another thing that I'm watching. This candle here, guys, all right? This candle here, if this turns out below the, of course we talked about it, as long as this channel holds, but if this becomes a large red bearish engulfing, then we don't like that, correct?
Mm-hmm.
We don't like, from a standpoint of, regardless of, if this turns out to be like this, and you can visually see it. It's very easy to see on investing.com. Then that would be the precursor. Yes, we might come down here, bounce a little bit. Remember, this is another resistance level here where we broke out from, which is 2180, where we closed that on Friday, right? So that's the reason why we kind of held that. So if we get a large one, which thumps down here, we will get that minor retracement bounce, but that will give me the first indication that we could very possibly come and revisit the levels we just discussed. So we have to watch whether or not, I repeat, we have to watch whether or not there's an extension of this baby, and how whether it becomes a large bearish engulfing. All right. So chart wise, let's keep it simple this week. We follow this one. We follow the channel one. We follow the channel. Oops, sorry, that's a different channel. This one, okay, and just three of them just need to follow that, and then just keep an eye on the thing, on the SPX and the E-minis on Thinkorswim. Now let's take a quick look at what's happening with the Russell 2000. So first, we're going to look at the actual Russell 2000. Oh, before I go, the kind of mention my thought. So bottom line is, if you really think about it, here's Brexit and here's here. Everything is fine here. We're staying above, we're still kind of hugging this line, moving along, all that stuff. So here we are. We're not even there yet. Let's talk about real big retracements from somewhere up here. In other words, we did all this massive, Armageddon type of thing, and we just simply came back to the year's high. You got it?
Mm-hmm.
Yeah. So that's it. I mean, sometimes you got to look at it simply. If we were up here I wouldn't be singing any sort of, trying to keep my bias on the long side. I'd be like, hey, come on, let's take it easy a little bit. Let's come back and retest these lows and this and that, retest the breakout line. But we're not even there yet. So that's just from a simplistic standpoint. Sometimes we have to look at it. All the screaming and shouting, but we're not even at where we were in August with all the positive backdrop that's going on. Now, let's take a quick look at the RUT. Wow, this is things that are drawn like way back. I haven't even looked at the chart lately, this one. So here we are of the RUT, the longer term picture. The Russell 2000, just like frigging Priceline. This is like a Priceline chart, honestly. The Russell 2000 is going to go to 1400. It is going to go to 1400. I'm telling you right now, and I'll tell you why. When you see, anytime you see this type of massive injection of liquidity, and then at the same time, look at the shape of, and this is something that I had drawn from here. And I'll tell you, I'm a bit disappointed myself. I did very well with the Russells in the initial stage, but this stage, I really wasn't trading the Russell. I'm doing really well in some other stocks and stuff, which I want to showcase some of them, which I think you guys should definitely have some positions in. But whichever the case, this move here from the 1280 level up to this 13.012 level or so, I really wasn't around. I mean, I was around for a good portion of this. As we talked about weeks ago. Remember that? I said the Russell 2000 is, So looking at this here, the difference between the Russell, every single indices has different characteristics. The Russell 2000 is full of regional banks, full of biotechs, full of small energy companies, and they're all doing well. So saying all that, when you look at this here, look at the shape of this, it's not something that's telling you I want to crash and burn. It's basically telling you, yes, I might reset down to 80, but I want to go higher. And this is the first time, and of course you heard it in the news, that I've seen, and the indicators are showing that, where you have had this bigger move, this quick, a lot of money went in. Different reasons. One, it was the most heavily shorted indices. You couldn't turn on the TV with people telling you how badly the bear market, the Russell 2000 was. You got highly leveraged positions which had to be unwound, short squeeze, and you got the macro drop that the overall picture will benefit U.S. Infrastructure and stuff much more than maybe some of the other multinational companies. So put in together, this is what you get. So looking at this here, at least purely from a channel standpoint, after it zigzags way and does whatever, unless the RUT breaks below 1244 again, you are going to hit 1400. And I'll tell you, the way this thing moves, and the Russell, if you guys noticed, it moves in increments of 10 to 20 points, bar none. You don't see that many days where the Russell's only up 5 points. Very few days, right? So just keep that in mind. The other thing I like about the Russell 2000 is that options are cheaper than the S&P, generally speaking. And other thing I like is you don't have to buy necessarily in the money. Always buy 5 to 10 points out of the money if you are on the directional bias. Got it? So if you're looking at the 12, if the Russell is at 1200 and the charts are showing it's going higher, in the case of the S&P, I'll buy in the money a lot of the times, maybe a little bit out of the money. In the case of the Russell 2000, I never should have used the word easily, but you can, from a tactical standpoint, buy the 1210s or the 1220s. Got it? And they will move fast and furious, as I've shown repeatedly. So you can buy 10 or roughly 5 or 10 points, or 10, in some cases 20 points out of the money once you start to see big moves. Got it?
Yes.
Okay. The other thing is, how did this turn red? Hold on. The other thing is that here, what do you see? This is a bull flag, period. That's a bull flag. You got a big pole and then you got a flag. Wow. So this is going to break out. Now, where can it break out? 1335. So in my opinion, we probably got another 30 points out of this, which is the upper end of the Bollinger. And the way things are moving, it's really nutty, but it's kind of like structured nuttiness. All right. Should use that as a new term, structured nuttiness. Okay. It could it could hit 1350 just from a round number standpoint. So if we're going to cash that 45 points or 30 points from that, keep that in mind. Throw a little bit of money in there and just leave it. Don't worry about it. I mean, just enough in there so that if it completely goes the other way, you're not going to be like, oh my God, because you're doing other stuff. Okay, so just as a tester, maybe buy 1, 2. And if it does go to 1350, 1335 as projected on the bull flag, you just basically triple your money. Got it?
Yep.
There you go. All right. So this is definitely very positive. Let's look at the weekly. The weekly is overbought, but the secondary indicator on the fast stochastics, the green line, is not.
More to go.
What was that, boss?
Yeah, it's got more to go.
More to go, exactly. Wow, Jesus. So, seriously, take your breath away. Yeah, more to go. And that more to go is basically what we are talking about from a standpoint, if you want to look at it that way, is round figures. Just looking at psychological round figures, we are at 13. We closed at 13. Where did our RUT close at? Oh, it closed at 13.15. Sorry. So you could be looking at, you could be looking at 13.50. Or if you look at the bottleneck on the Darvas, it's 13.16 and 12.84. So that's 32 points, right? Let's call it 30 points. Got it? So add 30 to this. Bingo. We arrive at 13.46. This move here. One more thing. Remember, it's not, generally speaking, on pure algorithmic, high-frequency trading, tactical moves, it's always a 3-candle move. Just keep that in mind. Whether it's a 3-candle daily, whether it's a 3-candle before it breeds, before or even a 3-candle hourly, this is it. We are talking about looking out, where you don't look at the screen every 2 minutes, or at least on Russell 2000. This is a 3-candle weekly. Gotcha? We had a 3-candle weekly off the January, February lows. We had a 1, 2, 3, 4, 5, 6 candle. Of course, not at this size, not at this magnitude, which itself gives power. And I'm not going to make any Victoria's Secret jokes anymore, okay? All right. I mean, civilized super husband I am is laughing, and my wife's laughing. She's like, "Oh my God," I said, "Thank God I didn't go into my Wall Street, New York mode." Just kidding. So saying all that, okay. So here we are. So 3-candle move, and then a flag. What if we create a actual bull flag on a weekly? Oh my Lord. That's going to be the next move. But whichever the case is, 3-candle brings us towards 1350. I think we can get that. There's your Russell 2000. All right. Couple of quick stocks. Okay, let me stop here for a quick second. Any specific questions on anything that's in your head and things that I'm basically putting out?
I want to do oil today again.
I'm sorry, what was that?
I want to do oil again today because I did good on oil last week.
Yes, and you have reasons to do well. Oil, it looks like Saudi Arabia and Iran, and this was one I'm going to post after this session today. Iran is apparently saying that if the deal goes through, oil could be at 55. Now remember, everything that those guys say move markets, correct? So from an oil standpoint, Iran is basically, they are saying that oil could go to 55. To read in between the lines, they're kind of bending to the pressure of some sort of cursory output cut. Got it? Because they are the ones who basically are holding back the output cut, right? Saudi Arabia said, pure strategic. Saudi Arabia has said correctly from the oil standpoint, look, we are ready to cut output, but only if Iran and a couple of the other renegades cooperate, correct? So Iran now is saying, reading between the lines, that oil can go to 55 on a reasonable deal. That means they are pretty much on board. Yes?
Agreed.
Exactly. That's just geopolitics. That's just the way things work. Because it's kind of linear. Read in between the lines type of thing. So saying all that, let's look at the weekly. The weekly on oil is 52. This is oil futures. That means it's roughly 55 on real oil. So if you look at the Darvas, this is a very positive chart. I don't know how there are people out there still screaming $30 oil. I've read pieces like $30 oil, $40. I'm like, what are you guys talking about?
They watch CNBC too much.
You know, it doesn't matter. It's just, no, I'm talking about like on the bull, on because I read like many different things, and even on StockTwits, guys who are like oil traders. I'm like, Jesus Christ, look at this. It's telling you that the low end of the ball is 42. We are right there crossing over the 34. This is definitely a bullish chart. This is a beautiful head and shoulder with the neckline all the way at 62, which is a retest of the 150-day moving average. End of story. Right?
See that?
There you go. Yeah, it's clear. It's clear. Yes, of course there's going to be volatility. Somebody will say, oh, Iranian minister, right about when he was about to cut the output deal, but he had to run to the bathroom. Okay, fine. Well, it's going to drop like, $3. Seriously, that's what they do, with that stuff. There you go.
Yep. End of the year, 60.
Now, this is what is the true neckline, actually. 1 second. Right here, boys. I think it's price level 2. Okay. Let me make it there. That's yep. The actual neckline. What is it? Price level 3? Okay, right there. So that's the neckline that if we break the 52 or so, 51, 55 on oil futures is where we hit that level. And that's where you get the real kind of, this being the left shoulder, if there's a right shoulder, that's when you get a large pullback, right? In the meantime, all cooperative. Look at that. All cooperative. So UWTI on the ball. And UWTI moves. Jim plays it. I play it. Tom, you should definitely play it. Straightforward, common. That's it. Even if it goes the other way, you're not dropping $10. You know what I'm saying? So, terrific one.
Right. Option
yes.
Premium. Right.
Exactly. No options, just pure common. Good way to do it. And I like the fact, since I even alerted it, it's that it moves $1, $2, and you don't have these other external crazy factors that control other indices and stocks, other than the fact that it'll move up and down. So very nice. So saying all that.
Real quick question.
Yes.
What about the Credit Suisse thing about not issuing any more UWTI shares? What was that about?
I don't know. When did they say that? I didn't know that.
That popped up on TD Ameritrade under the news profile for UWTI. I think it was like when we dropped down to 1840, 1860. I think it was Thursday or Friday.
Generally speaking, these are not long-term vehicles. ETFs like this, okay, these are second derivatives, third derivative, leveraged ETFs. So one of the key things about ETFs that I used to tell my clients way back in the old days, okay, this is not something you get married to and say, oh, I'm going to come back and revisit it 6 months later, because there is always erosion because of all the what do you call it? What's the word I'm looking for? There is erosion in the underlying assets because they're derivatives. Get it? So the bottom line is you're looking on 1, 2, 3 day type of place. Don't worry about that erosion factor, which they talk about. You worry about the erosion factors if you have a big chunk of it and you want to hold it for a year. Then things might get a little bit tricky. You're using it as a trading vehicle. So so from that standpoint, by not, let's say that what you didn't know, that they're not going to issue any more shares. Good. That means they're not going to dilute it anymore. You get it?
Okay.
And the reason they said that, just so you know, the reason they said that is because they don't want to keep on issuing more shares to accommodate more gullible retail traders and public to get into it.
I think they indicated that they had an influx of like 217 or 271 million dollars came into UWTI in like the last month or whatever.
Yes. And this
is like, oh no more.
Exactly, because they have to watch their butt on that type of stuff. Okay, so there you go.
Okay,
so
that makes sense.
So use it as a trading vehicle. 48 to 72 hour holds. Go back and forth. Don't hold it for more than, don't even bother holding it for a week, because oil's too choppy to hold for a week, even though the longer term picture is great. Want to play longer term picture on oil? You have the EOGs, you have the USO and that type of stuff. All right. So that's the way to go with longer term views on oil. This is again on UWTI, the Flying Eagle, as I like to call it. So there you go. And at this point, you're looking, this is the level that I showed the other day. Call it 21. And this $21 level, this is the level, in my opinion, where it really breaks out. Now, what does really breakout mean? Well, it's not a biotech type of breakout. It means that you're going to get another 10% on it, and possibly the real breakdown on the UWTI. The supply point was back a couple of weeks ago, and that was at around the 24 level. So on a move level, I am looking at the thing moving up to 24 on a max move, on a deal output cut. I mean, oil deal coming out of OPEC, which is in the next week or so. Got it? So this is the picture. There's nothing to it. A breakdown would be below the 18 level, simple numbers, and you do not want to be holding it below that 18 level. All right? So that's it. You know, if they really screw up, temporarily oil's going to dip hard, and you never know. So bottom line is, structure looks fine, but any break below 1798, any break below 1798 is not something you want to be held hostage to. Got it?
Yes.
There you go.
Got it.
Money in your pocket. There you go. That's it. You do have it left shoulder at, make it bigger. You do have a left shoulder, gentlemen, at 17 from an extreme standpoint. So again, there will be mild panic around 18, but even 17 holds, that's the real right shoulder. Fair enough?
Yes.
Beautiful. All right. Now, let me show you a couple of stocks I am very bullish on from a tactical standpoint. Doing really well on Amazon and stuff like that. Big boys, but let me just bring it out. I'm trying to drag it down here from my other screen. Okay. Twilio, just from a tactical standpoint, no, nothing. This is powerful. The first candle, it will be a 3-candle move. End of story. 3-candle move should bring us up to somewhere in this vicinity. Okay, the 3-candle move. Let's project it out. Max move would be somewhere between 45 to 47, possibly a psychological overshoot to 50. Options are elastic. They move with the price, which is very important. They are not crazily valued. They're between $1 to $3, and you can make some decent money. First, weekly, and this is a swing. Don't bother what happens on a daily. Unless something breaks down, of course, that's a different story. And the breakdown level would be considered to be in the range of $30. So, not 30. The breakdown would be somewhere, I would say, 34 around here somewhere. But barring that, first weekly move, very nice. Always 3 weeks. 3 weeks. Don't forget, this was one of our biggest winners back from the IPO days. We've got back down to that. Love it. You do not get these chances too often. End of story.
Good.
Okay, you can buy some common too. Again, so 3-candle move would jettison us up into the 40s. Big return on the call. I traded it twice in and out recently. Options move very fast. I had a bunch of them. I'm not going to look at a gift horse in the mouth. Rebought them back, period. But this is the swing picture. Let's take a look at the other one. Just some different names, which is a fantastic structure and an expansion candle on the weekly, which is wild. Expansion candle on the weekly is not something you see too often. And it did that on Friday because this is not market dependent. This is Nutanix, right? One candle, expansion candle. Wow. Another expansion candle, which is likely from a technical standpoint. Remember, it can slip a little bit, and then expansion candle brings it to 40. Stocks at 34. Stocks at 35. Fair enough? That's the max move that I'm looking at, gentlemen. Very clear cut. Nice. Let's take a look at our favorite Amazon. Seasonal factors, in my opinion, will drive the stock up to $800 and overshoot.
Really?
And let me just tell you one thing. Market has no frigging memory. All right? Fund managers who basically, especially smaller hedge funds, which basically sold the stock on what? They're going to spend more money expanding their business. This is a stock which is considered, most people don't realize this, Amazon in many fronts is directly correlated with what sector? I know it's correlated with tech, NASDAQ 100, it's a technology stock, blah, blah, blah. But what is the other sector that it's heavily representative of?
Retail.
Thank you. And the story.
Ultimate retail stock. Yeah.
Exactly. Ultimate retail
love
stock.
that place.
Okay? I mean, it's just like 7 morning, I'm sitting there in my potty, reading my stuff, okay, getting ready to take the dogs out, freaking phone, front, concierge desk, automatic, they're calling. I'm like, what the hell? Amazon delivery. I'm like, what are you guys doing delivery at like 8 on a Sunday morning? Guy's a real nice guy and stuff. All these boxes, I said, just leave it at there, outside. It's all security desk doors. I had to run down and let him in because he's one of those guys like he wants to scan it, and while I'm picking it up, I'm like, what do you want to do? Put my picture up on Newsday or something, I mean, seriously. So just an example of what's going on. 8 o'clock on a Sunday morning. So, and okay. So here is your weekly picture. Here's your weekly picture. All that hoopla, Amazon finished, is going to go down. Big deal. Did anything change? Did anything change? Nothing changed on the weekly. It came down. Beautiful retest of the lower Darvas. Mid-Bollinger didn't even come to the 50. That's when it gets worrisome, gentlemen. If it came down to the 50, which it did overnight, it did it? I can't remember, but I remember trading it. So basically, no, it didn't. I don't think it came down here. But anyway, if it hit the 50 and kind of vacillated around here, would that be good or bad?
Bad.
Thank you. Thank you.